webinar. Hi, everyone. Thank you for joining us today. We are really excited to present this new webinar to you. It is the last new webinar in our new webinar series where we have broken down the 7 pillars of a successful sales tax strategy. If you missed one of the previous webinars or have not participated in our normal rotation of webinars, make sure you're on our email list and we'll let you know when those are coming up. Before we get started, I want to go over a few quick housekeeping items along with some quick introductions. If you are here for CPE credit, you do need to do a couple of things in order to receive that CPE credit. You will need to answer the poll questions as they pop up on your screen, and you will need to fill out the survey that pops up at the end of this webinar. If you have trouble with either, please send us a message and we will help you get that sorted out. A few more important things to note. If you have questions as we are going along, please use the Q&A button to ask. If you move your mouse around, it should pop up for you. We will do our best to answer questions at the end of this webinar, and if we can't, we will follow up with you via email. We also will be sending out today's slides and handouts in the chat in just a couple of minutes via email following the webinar and uploading them directly to Zoom. If you enjoyed today's webinar or our webinars in general, please head over to our Salt Vault. We have pre-recorded webinars offering CPE credit. You can contact Ellie or myself with any questions about this, and we are happy to answer any of your questions. Who are we? Sales Tax and More is a full-service consulting and solutions firm. Our team of experienced tax professionals is dedicated to fulfilling any of your state tax or related needs. We do a lot of returns, registrations, consulting, research, and like our name states, more. A little bit about our founder, Mike. Mike's state tax knowledge is very well-rounded, and he has helped thousands of companies of all sizes in all industries. He's especially well-known for his work in the e-commerce industry. And with that, Mike, take it away.
Thanks very much, JC. Really great intro. Appreciate it. We've got a lot of information to cover today. We're going to talk about some certificate basics. We're going to talk about good faith acceptance. We're going to talk about why certificates are so important. We're going to talk about validation. You can't just accept a certificate. Someone's got to be checking it to make sure that it wouldn't get kicked during an audit. We're going to go over some common errors, and then we're going to talk about certificate dates, some best practices, and then we're going to get into drop shipping, because when we're talking about certificates, perhaps people have the most problems when you combine certificates with drop shipping. So we're going to go over that. We're going to talk about alternative documentation that can be accepted when you're doing drop shipping, so long as your customer does not have nexus in a state, they can issue alternative documentation. And then we're going to open it up to questions. I do want to let everyone know, normally I have my video on, but we're having some bandwidth problems today, so I've turned the camera off. Hopefully the bandwidth doesn't give us any issues, and you'll be able to hear me perfectly. And with that, JC, why don't we go to the first polling question?
Absolutely. That poll question should be on everyone's screen, and we would like to know, which of the following do we mention in almost every webinar? It starts with Nexus. It all starts with taxability. Nexus is the only thing that matters, or none of the above. Answers are rolling in pretty quick here, Mike. We're going to give him a few more seconds to answer. And I'm going to go ahead and close out that poll question.
All right, so we must have some frequent flyers here because most everyone answered. It all starts with Nexus, and that is what we generally say, because if you don't have this linker connection that we call Nexus with a state, then the state cannot require you to do anything. So that's the first thing. It all starts there. Also wanted to remind everyone that today's webinar is scheduled for 90 minutes, and it will be 1.5 CPE credits. So let's get into it. We're going to be talking about exemption certificates. And once you're registered, you must, and you don't have an option here, you must either collect the sales tax or collect a properly completed certificate in lieu of collecting the sales tax, which is acceptable to the delivery state. And that's real important. It's got to be acceptable to delivery state. And when we get into shipping, that'll be a real problem. The reason why we need that is because you're collecting a certificate in lieu of collecting a state's tax. So you want to make sure, if I'm not, collecting tax, that I have the right certificate, that the states whose tax we should be collecting will accept that certificate. Now, let's talk real quickly about the sourcing of tangible personal property. That's what we're going to concentrate on today. And states are generally going to base their sourcing rules for tangible personal property where the purchaser or the purchaser's representative take possession. So common carriers are generally not considered representatives. I often get a lot of questions. Well, Mike, what happens if my customer orders the common carrier? Well, what happens if they pay for the common carrier? That's generally not relevant. All right. Common carrier is not considered a representative. So where does your customer take possession? Usually wherever it's being delivered. So, the ship to location is what we look to in most instances, unless someone's coming to pick it up at your warehouse, or they're sending, someone who's not a common carrier to your warehouse to pick it up there. Then they're, taking possession at the warehouse. So it's wherever possession is changing hands, common carriers not considered representatives. Incoterms in the United States, Incoterms are generally ignored. So as I've mentioned, in most instances, it's the ship to or delivery address is where the tangible personal property is going to be sourced. So when is an exempt sale not exempt? Well, when it's not properly documented. This is really important. And this is why, validation is so important, because if you don't have the exemption on the correct paperwork, if you don't have, it completely filled out, if it's not documented, then the state will generally not recognize it as an exempt sale. And that becomes a big problem. So here are some common exemptions. I mean, there are, tons of different types of exemptions. But the ones that we run into most frequently are going to be your sale for resale, your manufacturing exemption, your entity type exemptions like nonprofits or religious organizations, governmental exemptions. And by the way, not all governments are exempt, local governments. The state of California specifically, municipalities pay taxes. Hawaii, municipalities pay taxes. So we can't just assume that because someone's a governmental entity that they get to buy tax-free. The agricultural exemption, and then construction-related exemptions. Those are the big six. Now, some states have general exemption certificates and or resale certificates, but other states have really specialized certificates. Some of the the states follow the common exemptions on the previous slide, but a state like New York, they've got a separate certificate for the promotion of materials, capital improvement projects, textbooks, even racehorses. So lots of different types of certificates out there. Now, we're going over certificate basics right now. So a blanket certificate, on each certificate, it has a box, is this going to be just for this transaction, or is this a blanket certificate? You generally want to check blanket certificate. And your vendors are generally want you to check that also. Otherwise, every time you do a transaction, they have to get a new certificate, and that gets old real quick. So you're going to want to check the blanket certificate box. And so long as you're buying the same type of items that were on the first certificate, you don't have to provide another certificate. When collecting certificates, you must make sure the new purchases are the same type, because what I've seen is you've got a blanket certificate on file, but you buy something very different than what you bought last time. And when you get audited, or when your vendor gets audited, they're looking at this and they're saying, well, you purchased this, but it says something else on the certificate, and then that gets kicked during the audit. So again, you got to make sure that these certificates are going to survive an audit. Otherwise, these sales don't get recognized as an exempt sale. And we want to make sure that we have good faith acceptance. So in general, good faith acceptance means that if a certificate is on the correct form, it's completely filled out, it makes common sense. And this is important. This is one that people skip sometimes. We're going to talk about this a little bit more. And there is an actual exemption that the certificate is being issued for, then the seller does not have to put on a detective's hat. Okay, I don't have to put on a detective's hat to see if all of this information is correct. I don't have to do any digging. I can accept it in good faith. And the reason why you want that is because if there are any issues, then the state will generally pursue the purchaser. If there's a good faith acceptance. If there is no good faith acceptance, then the state will generally pursue the seller if there's an issue. And I think that slide reads backwards. With good faith acceptance, the state will generally with good faith acceptance, the state's going to pursue the purchaser. They're going to pursue the seller if there is no good faith. Now, when we talk about common sense, on every certificate, there's some place where you need to say what you're buying and what your line of business is and why you're purchasing it sometimes. So if I'm purchasing something for resale, and I put down that my line of business is software development, and I'm buying one desk. Now, does that make sense? Does that make common sense? If I'm buying one desk and my line of business is software development, I'm probably going to be using that desk inside my business. So in this instance, the seller should reject that certificate and they should charge the tax. Or at the very least, ask questions. Hey, why are you buying one desk for resale when you're a software developer? Well, we're offering a whole new suite of office products at this point, and this is just the first. This is going to be our sample desk that we're going to start off with. So maybe it'll work, but you got to at least ask the question. You got to make sure that you're not going to get this thrown out because it doesn't make common sense. You got to document why it does make sense. So good faith acceptance, very, very important, because you don't want the state pursuing you. If you're accepting the certificate, you want them to pursue the seller. because the improper use of a certificate is a criminal offense. And the seriousness of the offense is often based upon the amount of tax being avoided. Now, this offense can be a misdemeanor, could be a felony, usually just results in criminal penalties on top of the civil penalties and interest. But in serious cases, jail time could become an issue. Not trying to scare anyone here. It could happen, generally not going to happen. Now, this is not just an issue for purchases. Seller need to worry also. An example where sellers need to worry. I was working with one company, and the salespeople were coaching the customers on, hey, if you come with us, you don't have to pay sales tax. Just give us this form. So it wasn't really a sale for resale. They were being coached on how to fill this out in order to avoid the tax. Um, a big example of this is Sotheby's auction. They state of New York went after them because this is exactly what was happening there. They were telling their customer, one customer in particular, hey, don't pay the sales tax. They went after the customer, and they went after him for like $9-10 million. I mean, he was buying big pieces of art, but they went after Sotheby's for $30 million. So sellers need to worry about this also, the improper use of certificates. You want to make sure that you're doing this correctly. You want to make sure that you're questioning your customers if something doesn't make common sense. And you definitely don't want to be coaching your customers. They need to tell you they're exempt. You can't be telling them they're exempt. How can you accept something in good faith if you're the one who's telling them they're exempt? So they got to come to you. They got to let you know I'm exempt and here's why. Then you can help them fill out a certificate. You can make sure they get the right certificate, but they got to tell you first that they're exempt and what type of exemption they qualify for. All right, so expiration dates. In some states, the certificates never expire. In other states, the expiration may be stated on the form. Sometimes it's not stated on the form, and you just have to know the state requirements. In some states like Florida, expiration dates are specific to the type of exemption. For example, resale certificates generally good for 1 year, while other types of exemption certificates are generally good for 5 years. So a lot of information here. Now, when you're updating certificates in states that expire, pretty much a given. You don't want expired certificates. I mean, if the certificate expires, you want to get that updated. However, even in states where the certificates don't expire, we expect we suggest, not expect, as a best practice to update your certificates every 3 to 4 years. And the reason why we say that is because audit periods are generally going to be 3 or 4 years, and a lot can change in a 3 to 4 year period. So while the certificate you have on file, it may have been valid when it was accepted, it may have been perfect, but at some point over that 3 or 4 year period, it may have become invalid. I looked at a company one time, and there was one certificate in there. It was 27 years old, and I'm sure it was good when it was accepted, but so many things had happened over that 27 years. I mean, anytime a sales tax number is going to change, that's usually going to invalidate the certificate. This company had changed entity types, it had changed ownership, it even changed states. It moved from Texas to Oklahoma. So having a Texas certificate on file doesn't really help when this company's located in Oklahoma. So a lot of times these changes are reflected in our other systems, our invoicing system, our CRM, but it often doesn't get updated on the specific certificate. And that's because a lot of people aren't electronically keeping, more and more nowadays. But still to this day, when we talk to some companies about how they store their certificates, they're stored all across the country, in filing cabinets, and each office is responsible for collecting them. That is an absolute nightmare. How does one branch know what the other is doing when the auditor comes in? You got to reach out to all these different places, and something sitting in a filing cabinet, good chance no one's updating it. So another best practice, and we'll summarize these later on, is number one, when every 3 or 4 years you want to validate those certificates, but also you want to make sure that they're stored digitally and they're accessible by everyone in the company. So central access. They can be in different offices if you want the physical certificates, if you're going to keep them, but there should be a digital record somewhere that can be centrally accessed by everyone. And once you have the digital records, a lot of companies are, just why save the physical copies if you have everything stored digitally. All right, so missing, incomplete, or invalid certificates, that's the number one cause for large assessments in companies that are required to collect certificates. Okay, that's a huge number there. And there's a number of reasons why they have an outsized impact on an audit. One of them is because audits are done on a sample basis. So a lot of people are thinking, well, I'll make an exception. I'll accept this certificate because it's only going to be, $100 worth of tax. Well, it's not just the tax on that certificate. That certificate, because audits are done on samples, it's representative of a percentage of the population. So, this is an extreme example, but I was involved in one audit, and it was 60% of the assessment in this audit was related to certificates. It was a $3.5 million audit. We got all of the certificates except for one. And we got this audit down from $3.5 million to $17,000, except for this certificate issue. And the state was not exactly happy with us. So sometimes you can get a single item detailed and get it removed from the sample, but state doesn't have to do that. And they said, nope, we're keeping it in the sample. So this was a big, heavy earth-moving equipment, and the tax on it would have been, $8,000-$9,000, somewhere in there, which that's bad enough. No one wants to pay that amount of tax. But when it was extrapolated out over the population, it had over a $270,000 impact. So even one missing certificate can have an impact on a large audit assessment. Most people are not going to have that much tax on an invoice, but most people are going to have more than one missing invoice, and it works the same way. So whether you have one invoice with a large amount of tax or a number of invoices with a smaller amount of tax, they always have an outsized impact in the assessment. Now, a lot of people say, well, Mike, we've been doing this for years. We've never had problems with our certificates. Well, until about 2008 or so, the states and the auditors gave you a lot of latitude because they looked at things as substance over form. In other words, if the auditor knew that you had an exempt transaction, they give you a whole lot of latitude. And in fact, states said, you know what? Why should we go and audit these companies? If we know someone is a distributor, they don't have any retail sales, there's no money here. So a lot of companies weren't even audited. Then we had the Great Recession back 2008, 2009, 2010. States really needed revenue. The income taxes were down, the sales taxes were down. All the taxes were down, and all of the constituents out there, the citizens of these states, needed additional services. Think times were tough, so the state said, "Well, we can't raise taxes. That's not going to be a good thing. What can we do to get more revenue?" And they said, "You know what? We don't really enforce our rules about certificates. Let's go back and enforce them." And they did, and they collected a whole bunch of money because, if it doesn't matter, if there's never a reason to make sure you're doing things correctly, if the states aren't going to look at it, companies didn't. And all of a sudden, it started changing overnight. And that's when this became, a matter of form over substance. In other words, if you didn't have every I dotted, if you didn't have every T crossed on that certificate, if it was on the wrong form, if it was missing information, it got kicked in an audit. Now, you got a chance to come back and get it fixed in most instances. However, not all of them can be fixed. And now, since it wasn't, perfected when the auditor took a look at it, you lose your good faith acceptance. And one of the other things about good faith acceptance is if it's all there when an auditor comes in, they can't put on their detective's hat. They're not going to start digging. But if it's not, if it gets kicked in an audit, when you get the perfected certificate, now the auditor can put on their detective's hat. They can start digging. And maybe this company is registered now and can issue a valid certificate, but maybe they weren't at the time of the transaction. So lots of problems when the auditors start digging through these certificates. So you don't want to give them a chance. It's another reason why you want to have good faith acceptance. And when the auditor comes in, everything's good to go. You don't want these getting kicked during an audit. And that's the validation. And we're going to spend more time on validation towards the end. So when the economy started getting better, you think that the states might start loosening up on this. Not so. It's actually gone in the other thing. If anything, it's gotten worse over time rather than better. And every year, more and more companies are being contacted. They haven't heard that their competitors were being audited for this. I mean, so certificates are still a huge, huge issue. And that's why they're the leading cause. Now, if you don't have responsibility to collect certificates, that's not going to be your leading cause for a large assessment. Use tax is the number one or number two, depending on the type of business. But for companies that do have a responsibility to collect certificates, it's generally the leading cause for large assessments. So we talked about even one missing certificate can have a huge impact because these audits are done on a sample basis. So the tax on represented by one certificate, it's not just that, it's, whatever percentage of the population that transaction represents. So certificate validation, it's not enough to just collect a certificate. Someone's got to be reviewing that certificate for the most common reasons it could be kicked during an audit. As we said, if a certificate is on the correct form, completely filled out, makes common sense, the state will generally pursue the issuer. Hey, we got it right here. If the purchaser was not entitled to the exemption. However, if you don't have that good faith acceptance, or if it's missing, then the state's generally going to pursue the seller. So real important that number one, you have a certificate, and number two, that the certificate is actually something that the ship to state will accept. So it's on the right form, and it's completely filled out. I mean, that's the biggest reason why certificates are rejected during an audit. They're not completely filled out, and the seller is accepting them. So here's some really common mistakes. I mean, in the upper left-hand corner there, You put the purchaser's information. This is a Texas resale certificate. So all of that information has to be filled out. The second circle in the upper left there, that's going to be where you put your Texas number. Now, someone gives you a Texas certificate, you don't have to check and see if their number that they put in there, their registration number, their sales tax number is actually valid, but you do have to count the number of digits. If they give you a 10-digit number, well, the number in Texas is 11 digits. So if they give you 10 digits, something's wrong. They give you 13 digits, something's wrong. So you got to make sure it's 11 digits. Texas is a fairly easy state. If you're out of state, you don't have nexus in Texas, you don't have a responsibility for collect tax, then the line right below where it says put your Texas number is your out-of-state number. So if you don't have to have nexus in Texas, but you're taking a delivery in Texas, then you can put your out-of-state number in there. Then you're going to put the seller's information. That's on the bottom left-hand corner. You're going to put the description of items to be purchased. And it's got to be descriptive enough so that an auditor can make a reasonable decision, or you can make a reasonable decision as to whether it makes common sense. Because in the upper right-hand corner there, that's where you're going to say what type of business you're in. So that's the big common sense piece here. You know, what's being bought and what line of business are you in? Does it make sense that this person's going to be reselling this? And here's the biggest one. It's got to be signed and dated with the title of the signer in there. And so many certificates I reviewed, they're just not signed. They're just not dated. And that's going to get them kicked during an audit. So make sure it's completely filled out. A lot of companies think, well, it's mostly filled out. I'm good. I'm covered. And unfortunately, nowadays, you may be able to get it perfected. You may be able to make the argument that, yes, this is an exempt sale. You may be able to provide additional documentation. So there's a lot of maybes in there, but it takes a lot more work. And sometimes you're not going to be able to satisfy what the auditors are looking for. And all of a sudden, it goes against your error percentage there. All right, so here's some best practices. You got to have a system. All right, so you got to decide who's going to manage. You know, some companies, it's the sales team. Some companies, they're the first point of contact, so it makes sense that they collect it. Some companies, when a new customer comes in, they go to the credit department and the credit department sets them up. So that's a good place to be collecting certificates. In some places, it's the accounts receivable team. Some places, it's the accounting team or the sales tax team. So there is no one right way to do this, but you definitely have to have a system. You got to decide who's going to manage it, who's going to be the primary responsibility for collecting those certificates, and then who's going to be validating them. And I'll tell you, salespeople are good. They will get you certificates. Unfortunately, they don't know a whole lot about sales tax. They don't realize the importance about this. And in some instances, they care more about their commissions than about the well-being of the company. I've looked at some certificates. I mean, if it says the word certificate, I've found it in a file. Marriage certificates, birth certificates, death certificates. I mean, they all say certificate. So people are collecting that. Sales tax registrations, letters from the IRS. I mean, all sorts of documentation in there. So someone's got to be validating it. They got to make sure that it's something that the ship to state will accept if you get audited. And then we've got to make sure that we're storing the certificate centrally and digitally. and that we're updating our certificates every 3 to 4 years, sooner on the ones that expire. All right, so before we move on, let's go to our next poll question. JC?
Absolutely. I am launching that right now. And a quick reminder, you do have to answer these poll questions to receive CPE credit. And this is a true or false question. True or false, red flags are issues that draw attention to your account and increase the chance of an audit. We'll give everybody a few more seconds here to answer the question. Mike, do you want to go over this really quickly while the last few people are getting their answers in?
That is a true statement. So I think this poll question came from one of our other presentations where we talked about sales tax returns. So when you're doing your sales tax returns, there's lots of red flags in there that can raise your visibility on the radar of the state and can increase the chance of an audit. So that's a true statement. All right, so I'm going to be moving on, and we're going to start talking about drop shipping now. And at this point, a lot of people often ask me, well, Mike, what the heck is drop shipping? I've heard the term before, but I don't really know what it is. Well, quite simply, it's a fulfillment method, and it's where the seller doesn't have the inventory on hand when they're making the sale. And maybe that's their business model. Maybe they never have inventory on hand. I mean, a lot of people, it's a cheap, easy way to get started in a business. You know, sometimes though, maybe I usually have inventory on hand, but I'm out of inventory. All right, so I can either wait until my vendor sends me the information, the product. They're going to ship it to me, and then I'm going to turn around and ship it to you, which just delays things even more, and it adds costs. So, drop shipping fulfillment method where the seller doesn't have the inventory at the time of the sale, and instead, what they're going to do is once the sale's made, they're going to turn around and purchase the item from a third party, and then ask that third party, hey, Mr. Vendor, can you ship this directly to my customer? And that's what we call a drop shipment. So why is drop shipping so confusing for so many? Well, number one, it's at least two transactions. And I say at least two because I've been involved and consulted on where there's 6, 7, 8 different parties to the transaction. It's going from person to person to person. So it's at least two transactions. And that's a problem. A lot of us have a hard time getting our arms around that. And we're looking at this as one big transaction. It's not, it's at least two transactions. Terminology. Terminology is different from state to state. And if a state is talking about manufacturers and you're not a manufacturer, does all their information apply to you? Does it not apply to you? So the differences in terminology from state to state make this very confusing. Misinformation. Some of us get our tax advice from our competitors. Some of us get it from our friends. Some of us, it's hearsay. And there's a lot of misinformation out there. We can't assume that just because a company is big that they know what they're doing. I've been involved in so many instances where the big company is even more clueless than smaller companies, because the big company probably has someone who's been there for 20 years and they're using the rules from 20 years ago, whereas a smaller company probably staying on top of things a little bit better. So a lot of misinformation out there, a lot of disbelief. I mean, if you're telling your customer, Hey, I can't accept your Texas certificate. I got to have a California certificate. Your customer's saying, what are you talking about? A sale for resale is a sale for resale. What do you mean I have the wrong type of certificate? So there's a lot of disbelief in there. And then, a lot of us forget to apply the basics, or perhaps we don't know the basics on why things are the way they are. So we're going to go into the basics. But here's the first thing. When we're talking about drop shipping, I say keep it simple. We've got to look at each transaction separately. We've got to standardize our vocabulary, and we've got to remember to apply the basics. And if we do these three things, then drop shipping gets sort of demystified. It's a lot easier to understand. Now, typical scenario using some standard terms. All right. So a retailer, that's one of our standard terms. They're going to offer products that they don't have in inventory. So a consumer, the consumer is going to place an order with the retailer. And then the retailer is going to turn around and place the order with their supplier. So we use supplier because that supplier could be a manufacturer, it could be a distributor, it could be a whole bunch of different types of companies. So supplier, pretty nondescript there. So the retailer places the order with the supplier. It's just someone who's going to be getting you what you're purchasing. And then they ask the supplier to ship directly to the consumer. So this is the typical scenario using the standard terms. Now, why I say that of all the groups that were impacted by Wayfair, retailers who are drop shipping have probably been impacted the most. And the reason why is, number one, now you got potential nexus in more states. You got to worry about collecting certificates yourself in more places. You have marketplace complexity. A lot of times I, had clients who would say, well, I'll just pay the tax, when I purchase things, and then I'll repay myself when I collect the tax to the marketplace. Well, you're not doing that anymore. The marketplace is collecting the tax on your behalf. There's more registrations, more returns, more certificate requests from suppliers. So your suppliers have nexus in more states. So they're asking for more certificates. There's more knowledge to learn. And some of that knowledge involves alternative documentation. And alternative documentation can only be used if you don't have Nexus, but we're going to spend some time on alternative documentation a little bit further in. But sometimes if you don't have Nexus, you can provide your supplier with documentation that protects them and protects you. Now, why is this tough on the suppliers? Well, a lot of the same reasons. Potential nexus in more states means they have to ask for more certificates, means they have a lot more knowledge to learn. What does each state want you to do? On Wayfair, a lot of these states are now counting resale in their thresholds. More registrations, sales tax returns. Here's one that's a little bit different, and I don't hear a whole lot of people talking about this. This comes to the good faith acceptance issues. So what happens if your supplier, and you yourself has made more than 200 shipments into a state for one of your customers? You yourself have put them over the threshold. So if they're trying to give you alternative documentation, can you accept it? Not in good faith, because you should have known that they had nexus in the state, and alternative documentation can only be used when the purchaser does not have nexus. So if you're underneath the threshold, you don't have to put on your detective's hat. You don't have to go out and say, well, hey, Mr. Customer, how many purchases did you do with that supplier, and how many did you do with that supplier? No, you're not worried about that. You're only worried about what you yourself did. And if you did $100,000 of transactions into one particular state, or 500, whatever that number is, if you've crossed the threshold yourself, if you've created the nexus for that customer, then you cannot accept the alternative documentation. So this is something to really keep in mind. All right, JC, next polling question.
Absolutely. That should be on everyone's screen. And we would like to know, what is one reason drop shipping is confusing? And the choices are: it's not, multiple parties are involved, the terminology is the same in every state, and everyone knows the basics. Quick reminder here, you do have to answer these poll questions to receive CPE credit. And we'll leave this open for just a few more seconds here. Mike, do you want to go ahead and start going over the answer to this question?
Sure. And we got an expert out there for one of you. The questions are not drop shipping is not confusing. For most of us, though, drop shipping can be. Oh, now we've got two people changing their minds. For most of the people, the biggest issue is that multiple parties are involved. So that's going to be the big thing here. The terminology is not the same in every state. It's different in every state, and not everybody knows the basics. All right. So why are drop shippers impacted so hard by Wayfair? Well, unlike many sellers, some drop shippers possibly only had Nexus in one of their states, or if you were in a state like Oregon, or a state like Montana, maybe you didn't have any sales tax to worry about. And now you could have Nexus everywhere, and you got to worry about collecting tax from your customers everywhere. And then you got to worry about not paying tax to your suppliers. How do you get out of paying the tax to your suppliers? You got to be able to provide them valid certificates in enough places. What are they going to accept? All right, so problems created by drop shipping for suppliers. Exposure. Maybe you're too lax on collecting certificates. Maybe you're too tough on collecting certificates. And this is just not a tax issue. Sometimes this spills over into customer service and sales. If we're not teaching our customers why we're asking for certain things, then they just think we're too tough, and they're going to go find someone who's not as tough. Not as tough means not as knowledgeable. Usually they find out the hard way that they should have been a little bit tougher. But maybe you don't have to be that tough. Maybe you could have learned about alternative documentation. And this is really dependent on inadequate education. Sometimes, internally, the company is not teaching their people internally. Sometimes it's not sharing knowledge with your customers. And it can lead to a loss of business. I mean, if someone says it's too hard to do business with you, they're going to go elsewhere. So this is not just a tax issue. This could be actually a customer service and sales issue. Problems for retailers, overpayment to tax. I mean, if you can't provide your vendor with the certificate that your supplier with the certificate that they need, they're going to collect tax. Or they may require you to get registered everywhere in order to provide them with a valid certificate, even when you don't have Nexus. And sometimes I've seen, retailers dig their heels in. Sale for resale is a sale for resale. and you ruined relationships. You had a good supplier and you wanted to win the argument rather than working with them, and now you're less one supplier. So problems are created on both sides here, whether you're issuing certificates or whether you are um, collecting certificates. It can hurt your business both ways. So you really have to educate yourself and the people who are involved in the process. All right, so let's get back to some basics. But before we do, let's go to the next polling question.
Absolutely. And that poll question should be on everyone's screen. We would like to know, how would you rate your Nexus knowledge? The answer choices are, what's Nexus? I know the basics. I have an intermediary knowledge, or I'm a Nexus expert, or like we like to say, a Nexpert. Another quick reminder, you do have to answer these poll questions to receive CPE credit. And Mike, these answers are rolling in pretty fast. And so I'm going to leave it open a couple more seconds, and then I'm going to go ahead and close it out.
Okay. I looked at some of the questions while you were doing the poll here. There's a question here. Is there a list of states that don't accept other state certificates? Never a straight answer. Usually it's depends. It's very fact specific. What are the circumstances? So if you as a purchaser have nexus in a state, then you need to be registered in that state. So as a seller, if your customer has nexus in a state, they can't use their home state certificate. That doesn't work. That only works. That's a type of alternative documentation. Alternative documentation only works when the purchaser does not have nexus in the ship to state. So we have a list of what each of the states do and do not accept. That'll be one of the upcoming slides, and we can go over that. But it's not a simple answer. Okay, another question came in. This last one I'm going to answer now. What are the best resources to look into for a seller outside of the U.S. for certificate requirements? Every state's going to be different. You know, if you're a seller outside of the U.S., you follow the same exact rules as a seller inside the U.S. And the states don't make it easy. There's not a whole lot of consolidated information out there. You really got to go, on a state by state basis. Either that, or you have to, pay for some of the research sources out there. But states definitely do not make things easy. Everyone's going to be a little bit different. All right, so back to basics. We've been talking about Nexus, and simple definition of Nexus is it's a link or connection with a state. Well, Nexus just means link or connection. When we're talking about taxes, it's the link or connection with a state. And this link or connection must be present before the state can require you to do anything, before the state can require a seller to collect its sales tax or seller's use tax, or pay its income tax or consumer's use tax. You got to have some sort of link or connection with that state. And that's why we say it all starts with Nexus. Because if you don't have this link or connection, if you don't have this Nexus, then no problems and no responsibility. That's as a seller. If you're a buyer, you've got to pay sales tax when your seller asks for it, because we're going to talk about that next. But As a seller, if you don't have nexus, you've got no problems and no responsibility. So we're going to talk about rates real quick. We touched on a little bit of how we source TPP earlier, and when we're talking about sourcing, where does the sale get sourced means whose rate should I be charging? So as we said, in most instances, it's the ship to or delivery address is where the TPP should be sourced. All right, so when should a tax be collected? Sellers generally required to collect the delivery state tax or certificate in lieu of the tax that is acceptable to the delivery state if what they're selling is taxable in the delivery state and they have nexus. Okay, this next line, very, very important. It's generally never based on where the purchaser has nexus. All right, so just think of a normal transaction. You don't call your customer up and say, hey, do you have nexus in this state? Because if you do, I got to charge you tax. If you don't, I won't charge you tax. We don't ask that question. It's who cares if the purchaser has nexus or not? It's all based on whether we, the seller, have nexus. If the seller has nexus in a state where the property, where the purchaser, where the consumer is taking delivery, whether it's shipped there or whether they're picking it up there, that's where that sale is sourced. And if I have nexus, I should be collecting the tax or certificate in lieu of the tax. So I don't ask my customer, hey, do you have nexus here? I don't care if they have nexus there. I have nexus there. That's what this is based upon. Wherever I have nexus, I don't have an option. I must either collect the tax or certificate in lieu of the tax. All right, here's our last polling question.
I am launching that and it should be on everyone's screen. Another true or false. We would like to know, in most instances, the ship to or delivery address is where TPP should be sourced. Answers are rolling in here, Mike, pretty quickly. And just another quick reminder, you do need to answer these questions to receive CPE credit. Mike, I'm going to go ahead and close this poll out.
Okay, and another question came in. I'm going to read this one here. Is it still good faith on our part if we take their state's resale certificate when they request to drop ship to another state? No, that is not good faith. And that's not going to protect you in an audit because you're required to collect the tax in the ship to state. So you need a certificate that's acceptable to that state, and you need to know what that state is going to accept or not. So, we're going to go over a scenario here. We utilize Texas and Oklahoma and California. California is one of the 10 tough states out there, and they pretty much, you've got to be registered in California to issue a valid certificate. There are some exceptions, but they're tough to make work. So in general, in order to issue a valid certificate in California, you must be registered. So, if the suppliers in Oklahoma and the retailers in Texas, and that retailer gives that Oklahoma the Texas certificate that is being shipped to California, that will not work. So if that Oklahoma supplier accepts that certificate and they get audited by Oklahoma, that's going to be kicked during the audit and they're going to be responsible for paying the tax. Actually, with the California auditor, I'm sorry, they get audited by California, they're going to be responsible for paying the tax, because since a valid certificate was not collected, they must charge the California tax. And California does things a little bit differently. They're the only state that I know of. It's not based upon your sales price to your customer. It's based on the ultimate sales price to the consumer, if known. Usually it's not known. So you've got to use the wholesale price plus 10%. And we'll walk through this example in more detail. So let's say that I'm selling you something for $100 and you can't provide me the correct certificate. You're not registered in California. And let's say the sales tax rate where I'm shipping it is 8%. Well, I don't charge you $8 worth of sales tax because I need to do the sales price plus 10%. So 10% of $100 is $10. So my tax basis is $110. So 8% of $110 is $8.80. So I'm still paying the $100. The sales price does not change. The tax basis changes. The sales price does not change. So I pay $100 and I pay $8.80 in tax. For many sellers, this is a big problem. They're not collecting that extra sales tax. And on our example, 80 cents may not seem like a whole lot of money until you got it over 3,000 transactions or 5,000 or 10,000. Or the difference is bigger than that 80 cents. So, moral of the story, no, you don't get good faith. You got to collect what the ship to state will accept. And if you don't, they're going to come after you, the seller. So let's work this out. As I mentioned earlier, a lot of people think of this as one big transaction, and that's how it's hard to get your arms around this. It goes from the consumer to the retailer to the supplier to the consumer. And I've seen some really, really smart people out there. They can be smart in sales tax. They can be, the best accountant out there, but they still stumble over this concept here. So, as we said earlier, we're going to keep it simple. We're going to treat it as separate transactions. And, the first transaction is between the consumer and the retailer. Pretty straightforward, usually doesn't give us much trouble. If I, the retailer, have nexus in the state where my customer lives, then, and what I'm selling is taxable, then I need to collect the tax. The second transaction, that's where we start to see some issues, and not in all scenarios. We're going to go through some different. There's 3 different ways that this can unfold, but the retailers is purchasing from the supplier and then asking that supplier to ship to the consumer. That's your second transaction. Now, first transaction, as we said, usually pretty easy. Most people can figure it out. I say that, but I work with this stuff every day. And to be honest, a lot of our potential clients, people come to talk to us, they don't even get this part down. It's tough for them. They don't understand the concept of nexus or where they have a responsibility to collect or remit tax. So for me, this is easy to understand, not so much for all of our clients and prospective clients. Second transaction, scenario 1, not a lot of issues here. In this one, the supplier does not have nexus and is not registered in the ship to state. So if we use our Oklahoma and Texas and California example, the suppliers in Oklahoma, if they don't have nexus in California where the consumer is, they don't have to ask anything of the retailer. They don't have to charge them the tax. They don't have to ask for a certificate, because I only have to do something if I have a link or connection with the state. No nexus, no problems, no responsibility for the seller. So I don't have to worry about this. It doesn't give us very many problems at all. This one's easy to walk through. Second transaction, the supplier has Nexus and the retailer is registered. Well, in this one, same three states. If the supplier's in Oklahoma, they have Nexus in California where the consumer is, then they have to ask the retailer in Texas for a valid California certificate. And if the retailer is actually registered in California, no problems. You just give them the completed California certificate. So this second scenario, pretty easy also. It's this third scenario that gives us the problem. And in scenario 3, the supplier has Nexus in the ship to state, and the retailer is not registered. So if the supplier has Nexus and or is registered in delivery state, then the supplier must ask the retailer for a certificate. And if the retailer is not registered in the consumer's state, then the supplier may have to charge the retailer a sales or a use tax. Or perhaps they don't have Nexus and they may be able to take some sort of alternative documentation. We'll go over that in a second here. But this is the one that trips most people up. So as we've been talking, the supplier has the Nexus in California. The retailer does not have Nexus in California, so they're not registered there. So how does the tax work in this scenario? So we got to remember the basics. The delivery state determines which state's rate or certificate to collect. So in this instance, it's being delivered to California. So California is the state that we need to concentrate on. The nexus of the supplier is key. Seller never asks their customers if they have nexus in a state when deciding if they themselves need to collect the tax. It's based upon my activities. It's based upon my links with states, my nexus footprint, not my customers. And then the supplier must collect a tax or certificate in lieu of the tax acceptable to the delivery state. Got to do one or the other. I don't have an option. And then we got to remember a sale for resale may not be exempt if it's not properly documented. The state may not accept it as an exempt sale. So we've already established the seller must collect the California tax or certificate. There is no valid certificate to provide in this example. There is no alternative documentation. So you've got to charge them tax. And California, as we said, they base their tax on the sales price to the consumer, if known, or wholesale plus 10%. And the retailer, you don't have an option. You got to pay that. You don't say, well, I don't have nexus in this state, so you can't charge me tax. It doesn't work that way. If you want to do business with the retailer, if you want this transaction to go, this supplier, you want the transaction to go through, you got to pay them what they need to be compliant. The wholesale price plus 10%. So if the rate is 8%, that doesn't mean you're paying 18%. The wholesale price is $100. Tax basis becomes $110. It's the 100 plus 10% of 100 is 110. The 8% rate gets applied to that. That's $8.80. So there are alternative resale documentation available in a number of states. If the retailer does not have nexus in a state, some states allow documentation does not require being registered in a state, and each state is different. They don't make things easier. Some states are going to accept a home state certificate. Some states are going to accept the consumer state, that's the delivery state, certificate with a no nexus statement. Some states will accept the consumer state, that's the delivery state certificate with a home state number. The streamlined sales tax has a multi-jurisdictional certificate. And if you're doing a lot of drop shipping, we suggest this is the multi-jurisdictional certificate you use, not the MTC certificate, and we'll go through that why. Some states allow affidavits of no nexus. I'm going to say this, but as soon as I say it, I know that people are going to try to misuse it. Customer pass-throughs. So let's use our scenario. Let's say that we've got the supplier in Oklahoma, retailer in Texas, and the consumer in California. But if the consumer in California is another retailer and they are purchasing it for resale, then that is a valid exemption, and they can pass that exemption through to the retailer, who can then pass it through to the supplier, and that will protect everyone. However, very rarely is this done correctly. What we often see are the retailers saying, hey, you're registered in California, just send me a resale certificate. Even if that person in California says, well, I'm using this in my business, this is not a sale for resale. Well, improper use of certificates, criminal penalties. I mean, you don't want to get yourself into these positions. And every time I talk about customer pass-throughs, someone tries to figure out a new way to scam the system. It only works in very limited scenarios, very, very limited scenarios. And there are one or two states that actually will accept the sales tax permit. Most states, that will not work. Now, when you were asking about a list of states in our Salt Vault, and that's actually a paid for resource on our website, lots of good things in there. This is one of the things. This is what we call our alternative documentation chart. And it will tell you what each state will or will not accept. Lots of footnotes in there. So, let's look at the state of Arkansas. They're going to accept a home state certificate. They're going to accept the delivery state certificate with a no nexus statement, delivery state certificate with a home state number. They're going to accept the streamlined sales and use tax. They're even going to allow the multi-jurisdictional, the MTC. They're not going to accept a home state permit. They will accept an affidavit or letter with statements of no nexus. They will not allow a pass-through. So Arkansas is pretty easy, whereas we look at California, home state certificates, no. Delivery state certificates, no nexus statements, no. Delivery state certificates with home state numbers, no. The streamlined agreement, no. The MTC agreement, no. Home state sales tax permit numbers. And let me rephrase this. California will not accept the MTC agreement with a home state number. If you actually have a California number, they will accept the MTC agreement. Home state sales tax permits, no. Affidavits, no. Pass-through, yes. So, but again, be careful with the pass-throughs. You don't want to be caught, soliciting the improper use of a certificate. All right, so let's go through some actual certificates. This is the Pennsylvania certificate, and this is the most recent version. You really should be using this version. I see a lot of the older versions out there. Pennsylvania say they want you to use this one. So when you're filling this out, you start at the top, and right underneath where it says Pennsylvania exemption certificate, you're going to check state and local use tax. Then you're going to come down to the next one. It says check one, and it says Pennsylvania tax unit exemption certificate used for one transaction. You generally don't want to check that. You want the blanket exemption. So you're going to be checking box number 2. Otherwise, you're creating a lot of extra work for yourself and or your supplier. And sooner or later, supplier is going to be, just fill out a blanket. I don't want to ask you for one of these every time. And you're going to get tired of providing them. So learn to use the blanket certificates. All right, so then the name of the seller goes in there, the address. Then they get down to these boxes. And if this is for resale, you're going to check box number 3. And it says property will be resold under account ID. You can do one of two things here. You can put NA in there, or you can put your home state number. Most people put NA. And the reason they do that is if you look out to the right, it says if purchaser does not have a Pennsylvania sales tax account ID, include a statement under number 8 why a number is not required. So you right down here, no nexus. So this is an example of column 2, delivery state certificates with a no nexus statement. So perfect example of this. Now on the older forms, the only thing that's really different is instead of it being box number 8, it'll be box number 7, but you really should be using this form. You can just go out to the internet, you can type in Pennsylvania exemption certificate, and just download it. So real easy to find. All right, so let's look at this one here. And this one is an example of a delivery state certificate or consumer state certificate with a home state number. So New York is the example we're going to use here. And on the upper left, you're going to fill out the name of the seller, all of their information. The upper right, the name of the purchaser and all of their information. You're going to mark a box. Is this for a single use or a blanket certificate? Again, you want to be checking blanket certificate in most instances. Purchaser information. I'm engaged in the business of blank and principally sell blank. This is for that common sense piece here. So you got to make sure that you're giving enough information that the supplier can make a decision as to whether this makes common sense or not. Part 1, to be completed by registered New York State sales tax vendors. So you're certifying that you are registered, and that's why you're doing part 1. Well, if you don't have Nexus, you're not registered, you skip part 1. You go directly to part 2. And this says to be completed by non-New York State purchases. And you're certifying that you're not registered. And here's the next important part. Nor am I required to be registered. So if you have Nexus in the state of New York, you can't do this because you're required to be registered. So you can't honestly certify that you're not required to be registered. So it goes on to say, I am registered in the following states/jurisdictions. So this is where you put your home state name or country, and have been issued the following registration numbers. So you can put in, state of Texas number. If you're from Canada, you can put in your GST number. If you're from a state like Oregon, then you put not applicable. And then you check box number D all the way down at the bottom there. And this will protect you and your supplier. Here's the streamlined sales tax. And this is really good for people who do a lot of drop shipping. And if you're accepting certificates as a best practice, I say only allow this as the multi-jurisdictional. Do not accept the MTC. I see more people get themselves in trouble with the MTC. Every state that's listed on this form, this is page 1, every state listed on page 2 will accept the home state number. Or if no tax ID number, you can enter your FEIN number or your driver's license number. So, C, D, and E are the types of numbers that you can put in there. Pretty lenient. Up at top, You want to usually check that first box. Check if you're attaching the multi-state supplemental form. If not, if you're using this for one state, just put the two-letter abbreviation in there. And then you get in number 4, you check what type of business you are. So retail trade, manufacturing, wholesale trade, those are the biggest ones that we see there. Now here's what page 2 looks like. So reason for exemption. If it's resale, I write resale on the top and draw a line straight down to the bottom. I don't fill out every one of these. Identification number. If I'm registered in all of these states, well, you got to put in the actual registration number in each one of these. But let's say I'm using my FEIN number or my GST number. Let's say I'm from Canada. I write my GST number in on that first line, draw a line all the way down to the bottom. I don't fill out every one of these. Very, very easy form, protects you, protects your suppliers. And that's what the new one looks like. All right, this is the MTC jurisdictional certificate. The reason why I say do not use this, I mean, if you're shipping to a bunch of brick and mortar locations, this is a great certificate to use. Because if someone has a brick and mortar location, they're probably using this. If they don't have a brick and mortar location and they're trying to use alternative documentation, I mean, look at how many footnotes are there. Every state has a footnote. I think there's 32 footnotes total, 5 pages of these footnotes, and not one of them talks about what to do if you're not registered in the state. So unless you have something like our chart, and that chart is invaluable, by the way, I would join the Salt Vault just for that chart. Unless you have something like that that tells you where you can or cannot use the MTC certificate, I just wouldn't accept it if I'm doing a lot of drop shipping. Only when I'm shipping to individuals. So collecting tax from retailers, tax is generally based on either the price to the consumer, if known, or the wholesale price. Some people don't say anything about the price to the consumer. They just, price is the price. Sometimes it's the price of the consumer known, and then it goes to the wholesale price. California, as we mentioned, goes to the wholesale price plus 10%. So let's open it up for questions at this point.
All right, I'm going to jump in here for JC. So Mike, let's just jump right into these questions here. Okay, I have an e-commerce business and sell only on Amazon. Do I have to be concerned with all of these items? I had registered in many of the states and some have now canceled my resale certificate due to zero taxes sent to the state.
Gray area, hard to get an answer from the states on this issue. Some states are always a lot better than others. And California is actually one of the better states when it comes to this. So California has language out there where they talk about if you're selling through a marketplace like an Amazon, you don't have to worry about the resale certificates. Excuse me, the resale certificate, not a retail certificate. So some states have it spelled out very, very well. California does. Other states are sort of mum on it. And, if the state has canceled your sales tax license, then I would fall back to, do you have Nexus or not? Because in a lot of the states, they exclude marketplace sales when they're doing the threshold. So if you're only selling on Amazon, there's a bunch of states where you no longer have Nexus. So we suggest a bunch of our clients get deregistered because you have no reason to be registered there. So You have no reason to collect a certificate, and your vendor, your supplier, should accept alternative documentation from you, since you do not have nexus in a state. You can generally issue alternative documentation, except for the 10 tough states.
Thanks so much, Mike. Okay. Initial ship to of equipment is a warehouse in one state. Equipment is then shipped within anywhere between weeks to 1 year to another state for installation. Is the state of taxation the ultimate destination of the equipment?
My favorite answer is it depends. Each state is going to be different. Some states have what are called a temporary storage exemption. And depends on how long it's going to be in that state. It depends on when the customer or one of their representatives takes delivery. So a lot of times it will be taxable where it's temporarily being stored. And then the purchaser is responsible for a use tax when they bring it into the new state. Now, you get a credit for any sales tax that you paid that was legally due. So if you paid sales tax and it was 6% rate, and you're bringing it into a state with an 8%, you don't pay 8% to tax when you're bringing it into the new state. You only pay the tax on the difference, which in this instance would be 2%. If you're bringing it to a lower tax state, say you paid 8%, and you bring it to a 6% state, you don't pay anything. You don't get any refunds, but you don't pay any extra tax. So, it's hard to give concrete answers when it comes to sales tax, because everything is so fact dependent, and each one of the states looks at each one of the facts a little bit differently. So you've got to look at each situation separately.
All right. And last question here, Mike, before we close out. And, thank you everyone for sticking with us through this. We really appreciate it. But Mike, when they provide FEIN numbers, do they accept that in good faith, or do they push for a state number?
It depends on what you know. If you know someone has an office in a state, and you're delivering to their office, then in general, the FEIN number is not going to work unless you're in a state like New York, New Jersey, where the FEIN numbers are pretty much their state tax numbers with 3 zeros on the end in the case of New Jersey. So what do you know? I mean, in order to accept something in good faith, you cannot have any information available to you that would contradict what they're trying to give you. So if you truly don't know and they're giving you an FEIN number, then you accept that in good faith, if it's a state that will accept an FEIN number. And all of those 24 states listed on that streamlined sales tax agreement certificate, the multi-jurisdictional, will accept an FEIN number. So it always comes back to the common sense.
Thank you so much, Mike, and thank you so much.
I was going to say, what did you know at the time of sale? And if I know this is your headquarters state, then no, I shouldn't be accepting an FEIN number. If I don't know, could be your headquarters state, could be just a state where I'm shipping to one of your customers and you don't have any. I just don't know. I don't have to put on my detective's hat. You accept it in good faith.
All right. Mike, thank you so much for doing this webinar. Thank you, JC, for hosting it today. And thank you everyone for attending. Please join us for future webinars. Make sure you're subscribed to our email list so we can let you know when they are. And check out the other free resources on our website as well. So Mike, you want to close it up here?
Thank you everyone for attending. Please be brutally honest with your feedback. It's how we get better. And if you have any suggestions for future webinars, please let us know.